Joining us is Shivender Nigam, CFO at Cantabil Retail. Shivendra, good morning and welcome to the show.
Good morning. Thank you. Thanks for calling us. Thank you.
Always a pleasure to speak to you. Shivendra, my first question coming to you is, how has the festive season been? Because October, November, both of them, it was broken up. December, taking Christmas into consideration and the kind of sales that you see, what has your view been?
So overall, as a retail, we are looking forward. We all as a retailer looking forward for the festive season. Festive season was quite a decent one. The growth what we expected was almost reached those numbers. So overall festive season starting from the Diwali was good. December started in a decent manner, and we are expecting a good sale in the coming months as well. So overall targets we are meeting. Overall, whatever the growth plans were there, we are meeting. The consumer has put the most important part is that for the our business, few KPIs are very exciting. So few retail KPIs are very exciting. So overall things are in control, things are fine, and overall it looks like that going forward things are started from the festival season. It's going to be good.
Okay. So from here on, clearly you have a target margin of around 55% that you have indicated earlier, and a revenue growth of 18 to 20%, EBITDA margins in approximately 18 to 19% growth in the next 2 years, and PAT margin of around 20% in the next 2 years. Is that something that you maintain, or do you think that could be revised upwards?
So we did not revise any of our targets over a long-term basis. So as we started, we are expecting the growth of 18 to 20% in this financial year as compared to last year. And going forward on the same plan, we are doing our growth on the same way. We are opening our stores as well in the same way. So the overall target for the companies are same in terms of sales revenue, growing at the rate of 18 to 20% to make the company a 1,000 crore revenue company by FY26 or mid of FY27. As far as margin is concerned, yes, target is same as far as gross margin, 54-55% we are going to maintain the margin. As far as EBITDA margin is concerned, yes, 80 to 20% is the target. This year, slightly 1% up and down will be there. And the PAT margin, what we discussed, I'll just make a slight correction, is not 20%. That's the EBITDA we have been targeting for 18 to 20%. And the PAT margin, 11 to 12% on a longer and sustainable basis will be there. So all the margin and expansion from the company are same, and we did not revise our targets.
Okay. So overall, if you see the discounting patterns, the second quarter had more discounts because of muted demand, right? Taking that into consideration, how have you seen the second half of financial year 24? If the discounting will come back to normal, and if that happens, what will be impacted?
So in our case, we did not change our any long-term sales strategy, including our discounting scheme, right? So yes, there was a slightly a period we have been released, say for 1 week or 2 of the existing discount scheme to clear the inventory. So that's overall the basis. First half, you can say slightly on like earlier our margin last year was gross margin of 56%, but this year we are considering on a long-term basis 54 to 55% because some up and down curve is there in the market. So second half, we are expecting our normal discounting scheme, our normal schemes as far as business is concerned. So overall margin, what we have been discussed about gross margin, which is going to be maintained. So overall, we are not changing our any of the pattern and plan in terms of sales strategy or discounting scheme. So that would be intact.
Right. Shivendra, in terms of the regions, the focus has been North India, where 55% of your revenues come in from the north. What's the expansion plan looking like for the remainder if you look at central, because that's the next one where we have seen higher contribution?
Correct. So overall expansion plan is concerned, we are opening around 80 to 90 stores every year, and the same plan will be continued. There's a major, we are in 20 states now, except South India, main 4 region we are being there, and immediate plan for next 2-3 years to be concentrate on these areas only, 20 states being there, and 250 plus cities. So yes, North we are already there, Central we have been expanding, MP we have been expanding. And as far as Western is concerned, I think Mumbai and Gujarat is the next for us, which already we are having approximately 80 to 90 stores are there. So these are the splits. So overall expansion, except South India, would be continued. South India will be looking after 1,000 crore. Our target is that there will be entering after, you can say, 2 or 3 years. So expansion plan for the company on an overall pan India level will be as it is, yes, which is like now, and South India probably after 2 to 3 years.
Okay, and so clearly from what you're saying is that the demand is robust. You're looking at an aggressive store expansion strategy as well. There is category extension that we are seeing as well in terms of your business. Taking all of this into consideration, you had mentioned earlier as well 1,000 odd crores by FY26 is what you plan to achieve in terms of revenues, because that's what I read somewhere in one of the brokerage notes. So is that a number that you're targeting?
Absolutely. FY26 has a clear company target is to make the company the 1,000 crore revenues. FY26 or mid of FY, plus minus 5-10% is not a big deal. So FY26 is our first target to make the company a 1,000 crore revenue with a sustainable margin as of now.
Okay. And very lastly, would you be able to maintain your return ratios, or do you think you will be able to, increase, better them from here on?
So, like if you say we are working on the ROC approximately 37-38%, and on a longer basis, these were in the intact margin, but gross margin is very important, which is their target, maintaining it to 53, 54, 55%, and all the ratios like ROC and all that is going to be maintained, 38-37% approximately ROC and all the margins. So that's the long-term plan for sustainability.
Right. So this is going to be an interesting one. In fact, recently as well, you had BofA Securities Europe SA, which picked up around 2.87% stake in the company as well. And clearly, what brokerages are indicating is that they could be a re-rating candidate that could be on the anvil if all of the targets are maintained. Thank you so much for joining us on the show and sharing the views. So that's with regards to Cantabil Retail.